Hey, future CPAs, welcome. Today, we are going to level up your skills to absolutely conquer a super tricky topic on the LECPA: how to adjust the cost of capital for project-specific risk.
Here's our game plan for today's quest. We're going to start with the basics at level 1, then face the main challenge. After that, I'll teach you 3 pro moves to beat it, and we'll finish up with a rapid-fire boss level to get you totally prepped for the exam. Let's do this.
Okay, every great quest starts at level 1. For us, that means a quick refresher on the weighted average cost of capital, or as you know it, WAC.
So what is WAC really? Put simply, it's the minimum, the absolute bare minimum return a company has to earn on a project just to keep its investors happy. Think of it as the hurdle you have to jump over to actually start creating value.
I know, you've probably seen this formula in your sleep, but it's our fundamental starting point. All it does is blend the cost of money from shareholders with the after-tax cost of money from lenders, all weighted by how much of each the company is using. All right, now for the real challenge. You've got your WAC, you're feeling good, but here's the trap. Using that one single WAC for every single project is a classic mistake, and you can bet the LECPA loves to test you on why. This right here is the heart of the matter. What happens when a super stable, kind of predictable manufacturing company suddenly decides, hey, let's launch a wild, risky new tech startup, or the other way around? And this is the trap. On the left, if you use your company's low average WAC on a high-risk project, it's going to look like a sure thing. You could end up saying yes to a total dud. On the right, if you use that same rate on a safe, solid project, it's going to look weak. You might end up rejecting a guaranteed win. See? A one-size-fits-all approach just doesn't work. So, how do we fix this? Enter pro move number 1, the risk-adjusted discount rate, or RAD. It's simple, it's intuitive, and honestly, it's a game changer. The name pretty much gives it away, right? We literally adjust the discount rate to match the project's specific risk level. Think of it like setting the bar for a high jumper. For a world-class athlete, our high-risk project, you set the bar high. For a beginner, our low-risk project, you set it lower. We're matching the hurdle to the actual project. Let's see this in action. As we crank up that discount rate along the bottom, which is our stand-in for risk, watch what happens to the net present value. It goes down, right? This is the radar at work. The higher the risk, the higher the discount rate we apply, and the harder that project has to work to prove its worth. Okay, screenshot this with your brain because this is your golden rule for the LECPA. This is a study hack, seriously. If the project's risk is higher than the firm's average risk, you crank the rate up. If the risk is lower, you bring the rate down. It's that simple. Risk up, rate up. Risk down, rate down. Lock it in.
All right, time for pro move number 2. We're going to start thinking like a portfolio manager. Instead of just looking at one project in a vacuum, we're going to see how it fits into the whole big picture of the company.
So imagine we plot out all our potential projects. The further to the right, the riskier they are. The higher up, the better the return. Now, where do we want to be? Right there, top left corner. That's the sweet spot. High return for low risk. The goal is to build a portfolio of projects that keeps the company in that awesome zone. So the big takeaway here is this: stop judging projects on their own. Analyze how they contribute to the team, the firm's total risk profile. It's all about strategically building a winning combination of projects for the company as a whole. And now for our final pro move, and trust me, this one is a total boss move. It's called the Pure Play method, and it's your secret weapon, especially when you're looking at projects in a brand new industry or for private companies where you can't just look up a stock price. This sounds complicated, but it's really just a clever 3-step dance. First, you find public companies that do only the thing your project wants to do. These are your pure plays. Second, and this is the magic trick, you take their risk level, their beta, and you mathematically strip out the effect of their debt to find the pure business risk. We call that the asset beta. Finally, you take that pure risk and you add back the effect of your project's specific financing plan. It's like borrowing a recipe and seasoning it to your own tastes. And why go through all that trouble? Because this bottom-up beta is way more reliable. It's less noisy, meaning it's not thrown off by one company's random stock swings. It's forward-looking. And best of all, it's a total lifesaver when you have no stock price history to work with, which is super common for new projects or private firms. All right, you've learned the pro moves. You've powered up. Now it is time for the boss level. Let's see what you've retained with some rapid-fire LCPA-style questions. Get ready.
First question, focus. Which of these models has risk baked right into its DNA when you're figuring out the cost of equity?
Yes, that's it. The Capital Asset Pricing Model, or CAP. It directly incorporates that systematic risk through beta. Nicely get.
Next one, think about it. When you diversify, don't put all your eggs in one basket, which type of risk are you actually getting rid of? Correct. Unsystematic or company-specific risk. That's the stuff you can diversify away. It's the systematic or market risk that we can't escape and that we have to adjust for.
Final question. We talked about a key measure, one that describes a project's risk relative to the entire market. It was the star of our pure play method. What is it? And the answer is B, beta coefficient. Boom, you've officially aced the boss level. So, I'll leave you with this final thought to take with you to the exam. Your project's IRR is 15%. Your firm's WACC is 12%. Is it a definite go? The rookie says yes, but you're a pro now. You know the real answer is, it depends. And now you have the tools to figure out exactly what it depends on. Always adjust for risk. Now you're ready for the LECPA.